Dividend investing sounds simple, but many of the highest yielding dividend exchange traded funds are dangerous traps, and the best ones can easily be overlooked. That's why in the first part of this video, we'll go through the essential facts and performance information for the top 3 exchange traded funds in 2026. Then, in the second part, we'll look at the top 2 dividend investing mistakes and the best strategies from my 13 years of dividend investing experience. To compare the exchange-traded funds, we'll look at assets under management, performance metrics for dividend yield and 5-year return, expense ratio, the price and how to buy it, and, lastly, the main reason investors choose it. Please be aware that the data is from Seeking Alpha, Vanguard, and Schwab as of the time this video was made, and this is not financial advice. Part 1. The top 3 dividend exchange-traded funds. First on the list is Schwab's U.S. Dividend Equity ETF with the ticker SCHD. It's widely viewed as a core dividend holding for investors seeking meaningful income without sacrificing quality value stocks. It tracks the Dow Jones Dividend 100 Index, which screens for companies with steady cash flow, sustainable dividend payouts, high return on equity, and attractive valuations. Currently, the total net assets are over $86 billion, according to data on Schwab's website as shown here. Moving on to performance, we can see as of early 2026, its 5-year return is 37.2%, and its average annual return over the last 5 years is 7.4%. Meanwhile, the dividend was 3.2% over the previous 12 months and is paid quarterly, as shown on Seeking Alpha's website. The expense ratio is extremely low at 0.06%, meaning investors pay only $6 per year for each $1,000 invested. Its price is $31 per share, and you can buy fractional shares through brokers such as GoTrade or Trading 212. Also, you can buy it through brokers Fidelity, Vanguard, and Schwab. It's blocked for European investors, however they can get around it by buying the top 20 companies in SCHD, which make up roughly 70% of the portfolio's weight. You can do it easily by creating a pie in Trading 212. However, tracking taxes can get more complicated, so it's not a great idea. Another option is to buy UCITS compliant alternatives like iShares MSCI Quality Dividend Exchange Traded Fund. However, the performance will be slightly different. Lastly, here's why investors choose it. The portfolio leans toward industrials, healthcare, financials, consumer staples, and energy, which are value-oriented sectors with durable dividend earnings power. You can see I've listed out the tracking, assets under management, 5-year return, and all the other important info we went through here. I'll do the same for the others on the list, so you can easily see and compare them all. Compared with other broadly diversified options, it offers more than double the yield while maintaining exposure to financially stable companies. It strikes a balance between income today and capital appreciation tomorrow, making it one of the strongest core income options available. Remember, income alone is not the goal, but rather a sustainable long-term total return is. The second option is the Vanguard Dividend Appreciation Exchange Traded Fund, ticker VIG. It takes a different approach, as rather than chasing very high yields, it focuses more on dividend growth. The fund follows the S&P US Dividend Growers Index, which includes stocks that have grown dividend payouts for a minimum of 10 years in a row. This naturally selects companies with growing earnings, attractive balance sheets, and disciplined management. The assets under management are over $104 billion, which makes it larger than the first option. As of early 2026, its 5-year return is 61.4%, and its average annual return over the last 5 years is 12.3%. While that's much higher than Schwab's, you have to bear in mind that the dividend was only 1.6% for the previous 12 months, which is 1.6% lower than Schwab's option. It's paid quarterly as shown here on Seeking Alpha's website. The expense ratio is slightly lower than SCHD at 0.04%, meaning investors pay only $4 per year for each $1,000 invested. Its price is $225 per share, and you can buy fractional shares through brokers including Vanguard itself, Fidelity, Schwab, and Robinhood. Here's why investors choose it. It has over 300 holdings, with the highest amount in technology and financials, making up around 47% of the total, as shown here. Also, we can see from Seeking Alpha's website the list of the top 10 holdings, which include Broadcom, Apple, and Microsoft as the top 3. While its current dividend yield is lower than SCHD, it emphasizes growing income over time. For long-term growth accumulators, VIG is very popular. Vanguard was founded in 1975 by John Bogle and has been around since 2006, 4 years before the very popular VOO was launched, making it very trustworthy, and with over 20 years of performance data to analyze. Next, we have the Vanguard High Dividend Yield ETF, ticker VYM. It offers broader high-yield exposure with substantial diversification and tracks the FTSE High Dividend Yield Index and excludes real estate investment trusts. The assets under management are over $75 billion, which makes it the smallest on this list so far, but still very large compared to most other exchange-traded funds. Next, we can see the performance over the last 5 years is 58.3%, which is 11.6% annually on average. The dividend yield for the last 12 months is 2.2%, and is paid quarterly according to Seeking Alpha, as shown here. The expense ratio is the same as VIG at only 0.04%, meaning you pay only $4 for each $1,000 invested each year. Its price is $153 per share, and you can buy fractional shares. You can use Vanguard to purchase the shares or other well-known brokers like Fidelity, Charles Schwab, or IG. Investors choose it as it has very high diversification, with 400 to 500 holdings. We can see here that financials make up the top sector at 20.8%, unlike VIG, which has technology at the top. Also, the top 2 sectors make up only around 36% of the total, far less than the 47% for VIG's top 2 sectors. Because it is market cap weighted, it emphasizes larger established firms, as you can see here from the top 10 holdings. We have Broadcom, JP Morgan, and ExxonMobil as the top 3 positions. VYM works particularly well for retirees who want low portfolio volatility, a very well diversified portfolio, and a fairly high dividend yield. Just like VIG, it has been around since 2006, which adds to its trustworthiness and gives it a long track record. If you're learning something new, please consider clicking the like button and subscribing so you don't miss out on more videos like this. You might be wondering, what about covered call dividend ETFs? Some popular U.S. funds generate high yields by selling covered call options on stocks. Examples include option income strategies such as the JP Morgan Equity Premium Income ETF. Covered call ETFs can produce yields in the 8 to 10% range. However, there's a trade-off as upside is capped during strong bull markets. Option strategies add cost, and long-term returns may lag broad indexes. High yields in these cases come partly from derivatives, not just company profits. They can play a role in income portfolios, but investors should understand the structural limitations and higher volatility that come with derivative strategies. In the next part, we'll look at the top 2 mistakes and top 2 dividend strategies. The first major mistake is to focus on dividend yield. Many investors focus solely on dividend yield. A fund offering 8%, 10%, or even 11% per year in income can look irresistible. But dividends are only half of the total return. Remember, the total return equals dividends plus share price growth. If dividends are high but the portfolio steadily declines in value, you may end up worse off despite the income. This is the classic dividend trap. Ultra-high yields often signal limited growth prospects, financial stress, cyclical vulnerability, and over-leveraged balance sheets. In recent years, broad market exchange-traded funds tracking benchmarks such as the S&P 500 have significantly outperformed many high dividend yield funds on a total return basis. This is mainly due to the top 7 tech stock artificial intelligence boom, causing the S&P 500 to have abnormal gains over the last decade. However, we'll likely see dividend and value stocks in other sectors catch up over the following decade, as has typically been the case in history. The lesson is always to compare dividend exchange-traded funds to the broader market using total return and not just the yield. The second major mistake is ignoring tax efficiency. For many European investors, distributing dividends into their accounts is less tax efficient than accumulating and reinvesting them. When dividends are paid out, they are often taxed immediately. That reduces capital available for compounding. Over the decades, this can materially reduce final portfolio value. Accumulating exchange-traded funds reinvest dividends inside the fund, potentially deferring taxation and improving long-term compounding. However, there's an exception for retirees who need income, as then distributing exchange-traded funds may make more sense. But for most other people, the long-term accumulation through reinvestment is typically more efficient. If the goal of dividend investing is to own financially strong companies rather than simply maximize income, there are a few popular options. Firstly, we have value investing, which involves finding undervalued stocks that trade at relatively low multiples to fundamentals. Because these stocks are priced lower, their dividend yields often appear higher, but not necessarily because of distress. Historically, value investing has delivered strong long-term results. But performance moves in cycles, and over the last decade, growth investing has actually outperformed, largely due to tech stocks doing so well. The other way is to look for high-quality income exchange-traded funds by avoiding weak companies that artificially inflate yields to attract investors. To do this, we can screen for stable earnings, healthy balance sheets, sustainable payout ratios, and strong return on equity. Historically, quality-focused indexes have performed well across regions, including the US, Europe, and emerging markets. Before selecting a dividend exchange-traded fund, remember the following. Focus on total return, not yield alone, avoid ultra-high yields without fundamental support, and consider tax efficiency. Also, prioritize sustainable payouts and try to understand strategy trade-offs. Dividend investing works best when the yield is paired with financial strength, earnings stability, sensible valuation, and long-term growth potential. Also, here are 3 more important tips. Firstly, check the dividend distribution frequency. Most popular funds and all the funds on this list pay quarterly. However, some pay out monthly, which is better for those relying on it for income. But quarterly payouts are easier for long-term investors to manage. Secondly, use a tax-sheltered account. For example, if you're in the US, you can use a Roth IRA, or if you're in the UK, use a stocks and shares ISA, where distributions aren't taxed straight away. This becomes more beneficial for high-yielding funds. And lastly, use a dividend reinvestment plan if you don't need the income, to automatically reinvest dividends and reduce the need to time reinvestments yourself. However, you can also use an accumulating fund that reinvests dividends for you, and that's usually more tax efficient. Overall, the major pros of dividend funds are that they provide steady passive income, offer diversification that reduces the risk of picking individual stocks, and come with very low fees. Also, many dividend funds include companies in the financial, healthcare, and utility sectors, as these sectors tend to pay higher dividends. The good thing about that is it gives you diversification away from tech stocks or from an index that's heavily invested in tech, like the S&P 500. Tech stocks have performed incredibly well over the past decade, mainly due to AI. However, over the long term, the sector moves in cycles, so it can be seen as a positive if you have diversification away from tech. The major cons are that dividend payments are often reduced during market downturns, and high-yield funds are often riskier. Also, dividend funds can underperform growth funds, especially during a tech bull market, as we've seen over the last decade. While diversifying away from tech growth stocks after a huge rally might be seen as an advantage, we must also be careful not to miss out on future growth potential. Dividend exchange-traded funds provide a reliable stream of passive income and diversified exposure to cash-generating businesses. Nowadays, many people throw the phrase passive income around on social media because it piques their audience's interest. But how many of those ways of making money are truly passive when you dig deeper? Well, dividend investing is probably the closest you can come to a truly passive income source. However, it's not going to make most people rich like some want you to think. A 2 or 3% dividend yield is quite normal, but that's only $2,000 or $3,000 per year with $100,000 invested. Including the fund's growth, most of the options on this list would give you roughly 10% annual returns, which is about the same as the S&P 500 index. Meanwhile, dividend funds with very high yields of 5 to 10% are not delivering strong price growth. Therefore, it's unlikely they'll cover all your expenses anytime soon. However, it's still a very useful additional source of income for very little work once you've done the upfront research to pick the best fund. Dividend funds can form the foundation of a resilient and reliable income strategy that's designed not just to pay today, but also to grow tomorrow. Feel free to click the like button and subscribing if you found value from the video. Also, you'll find this video very helpful to watch next. Thanks for watching. I'll see you there.